Welcome to the Landlord Profitability Playbook podcast, where we share the best practices we use to help our residential real estate investor clients automate their rent collection and get on with their lives. Check out the show notes at landlordprofitabilityplaybookpodcast.com. This show is brought to you by Roost Real Estate Company, Property Management. To learn more about the services we provide, visit investwithroost.com. Now, here's your host, Chris McAllister.
Welcome back to the Landlord Profitability Playbook podcast. I'm Chris McAllister with Roost Real Estate Company, and I'm here today with my podcast partner, Laci LeBlanc. Good morning, Laci.
Good morning.
Today, we're going to continue our conversation about investor seasons. So real estate investing moves in seasons or cycles and never in a straight line. So the last time we got together in part one, for part one of this two-part series, we discussed the three investor seasons. There's the buying season, the neutral season, and the seller season. As well as we talked about how to tell what season you're in based on the three dials. And the three dials are price momentum, supply, and borrowing costs. And finally, in the first episode, we dug into the 6 mindsets that the most successful residential real estate investors among us share. And they are patience, preparedness, discipline, adaptability, stewardship, and conviction. So today, we're going to get tactical, and we're going to talk about how to make money when the deals dry up. We're also going to talk about a concept I call the Long BRRRR, or the HRRRR, and we're going to walk you through a history of real estate seasons in Columbus, Ohio, going back 30 years. How's that sound, Laci?
It sounds great. I'm a strategy person myself. As a marketer, I love the kind of big strategy conversations, but I think most people think about things in terms of tactics. I think they think about things in terms of, what are the practical steps I can take, or what do I do next? And so I'm excited to get folks kind of meet folks where they are and talk about what they can do.
Okay, perfect. So first segment today is how to make money when the deals dry up. And the first tactic I want to talk about is you protect and optimize the portfolio you already own. So when acquisitions are slow, right, when the opportunities are few and far between, operations, which is not sexy, I get that, but operations becomes your highest return activity. If you can lower your vacancy rates, if you can streamline maintenance, if you can renegotiate contract services, these aren't glamorous, but any improvement that you can make from an operational perspective always goes straight to the bottom line. So if there's not a slew of deals coming your way to evaluate, take some of that time, get an extra cup of coffee, and go back through your budget line by line and see where you can make some adjustments. Even small improvements matter. Just a 1% decrease in vacancy across 10 units, that's a rent check that you weren't collecting before. Trimming a vendor contract by, even a few dollars, it compounds over months and over, years. For the long term, it could be hundreds or even thousands of dollars. And the last place you want to look as you think about protecting and optimizing what you already have, don't overlook debt. Refinancing or restructuring loans when the opportunity arises, rates are high right now, right? But that doesn't mean there isn't an opportunity to lock in better terms, or even if you get the same terms, to do a refinance and free up some cash so you can set it aside for when the deals do start coming your way. Protecting what you already have is the first line of defense in a market like this.
I feel like for a lot of folks, that's probably like this area is very rehab and maintenance centric. And maybe we'll talk about that more in depth later, but I feel like that's kind of an area. Like Nana has a lot of properties, and right now she's waiting on a guy, right, to come and do some cabinets, or she's waiting on a guy to come and do some floors or some siding. And while she's waiting, nothing else is happening. So it's really just a delay in her collecting a rent check and her getting somebody back in that property. So I feel like for a lot of folks, the area where you can optimize might be rehab and maintenance related.
Yeah, and we are going to talk about that here in a second or so. But just to touch on that, we just hired our 7th W-2 maintenance person this week. He started on Monday, and all of that is because we have clients, myself included, that are actively looking at houses within or properties within our portfolios that make sense to do some upgrades right now while there's not much else going on. So tactic number 2 is build cash, build liquidity. Patience is only powerful if you're liquid, right? It's one thing to be, there's 2 ways to look at this, right? It would be worse if you had deals coming your way and you had no cash to act on them, right? So at least this is a time where there's no deals coming your way, which means it's the perfect time to figure out, how do we create some cash? How do we build a stockpile? How do we set up some reserves so that when the market does change, that we have some dry powder, as they say, to act upon them? And dry powder doesn't have to sit idle. Many investors park cash in short-term treasuries, money market accounts. Some people even, start investigating real estate investment trusts or REITs to earn money while they wait. Others use the time to just aggressively save, trimming personal spending. It's almost like, the first tactic is trimming your current operations, look for ways to optimize cash flow and so forth. But you can do the same exercise in your personal spending and on your personal budget. So the whole idea is, what can I do to set aside more cash right now so that when the market changes, and it will change, that you've got money in the bank so that you're going to be ready, right? You've got fuel for future acquisitions. Obviously, when the next buying season comes around, that investor with cash on hand, that's the one that's going to be writing offers, while others are going to be sitting around just wishing they had some reserves in place.
Yeah, I don't think that's very unlike life in general, right? The preparedness portion of it is you have to be looking ahead. You have to be looking at what's going to come next, which just happens to be where we are here. But I think it's a difficult thing when you start talking about it in terms of trimming personal spending. I think people get a lot more queasy.
Yeah. Well, I think there's a lot of folks right now that feel like, this is a tough economic environment we're in across the board, not just for real estate. So, I think a lot of people are already having these thoughts and conversations, with the family that, okay, maybe this is the time that we go back and take a look at our personal expenditures. Maybe this is the time that we go back and figure out which of those streaming services we don't watch every week, right?
We just had that conversation in our household. So because we, or maybe it's just the time where we look back and see where we're being a little superfluous. Do we really need every streaming service known to man is more the question.
Yeah, but the whole idea is that we've got to figure out, how do we live and work more efficiently? How can we set aside cash? How can we be ready? We're not doing it for a rainy day. We're doing it for when opportunity comes our way. So to me, that's a little
bit. That's it. That's the difference, I think. When you start to have this conversation out of a mindset of abundance, where you're not doing it because you're scared of not having enough. It's not a scarcity mindset you're entering into this conversation with. You're doing it so that you're ready for when the opportunities arise. So I think that's a really important distinction to make, is when you have this conversation, don't do it from the mindset of scarcity. Don't do it for like, well, what if this terrible thing happens? Or what if, that terrible thing happens? Or there is not the rainy day, but do it from the perspective of, what if this opportunity comes along? How do we need to be prepared for that? Because I think that really changes it. Really, you can let go of the queasiness then, and you can do it from a positive perspective where you're preparing yourself for the next opportunity that comes your way versus, for the next traumatic incident that comes your way.
Yep. And I think that's a great distinction, because I can be motivated to do that if I know it's because something great's coming around the bend. So the third tactic is expand your pipeline and expand your relationships. In hot markets, deals sometimes find you. In slow markets, you have to hunt. This is where relationships become everything. So a couple of suggestions: work with wholesalers, make friends with wholesalers who know where, distress is hiding, where the distressed properties are. Stay close to attorneys who see properties moving through probate or divorce. Build trust with property managers who know which landlords are burned out or cash strapped or, just ready to get out. And, this one's a little bit out there, but don't be afraid to go direct to owners with letters or phone calls. That one's a little tougher for me to get behind, because I think I still get at least half a dozen unsolicited texts every day about people wanting to buy this address or that address, we buy houses guys and so forth. So that one might be a little bit tougher, but I have to tell you, and I think this, yes, I'm in the real estate business, but I think this applies to every other investor. I've worked closely with several attorneys in town, but one in particular has been a great client, a great attorney for me. He's my personal attorney and so forth. And this was coincidental, but he had a client who also owns a plumbing company that our property management company works with. And he was the executor of an estate. And Tom, my attorney, had talked to me about, getting an opinion of value on the house so that he could file, for probate and all that. And out of the blue, a couple of weeks ago, John called and he said, I know we talked about selling the house, but if you're interested, I'm happy to sell it to you. And the price he quoted was perfect for me. The house is in pretty rough shape, but we're prepared to fix it up and so forth. But honestly, I think this might be literally the best buy I've made in the past 3 or 4 years. And it came down to relationships. Like everything else we talk about in all of these podcasts, everything comes down to relationships. But I can't stress enough how important it is that anybody that you work with, anybody that you want to help them remember, or keep it top of mind that you're a real estate investor and you're always looking for an opportunity. This is also the time to nurture your real estate broker relationships and lender relationships. Deals and financing options often surface through people who are closest to the action. And I think this is a good time also to make a shameless plug, Laci, for Roost Investor Gateway. That you can get that, you can reach that from our Roost Real Estate site. But the Roost Investor Gateway, that helps create pipelines and helps make, what do we say, invisible opportunities visible. It's a great tool for looking at literally every listing that's on the open market right now, and it runs it through an algorithm and helps you see whether or not it's a potential investment or not. So looking for tools like that. If you're in our market areas, you can go find it on the website. I'm sure there's other tools out there in the world, but that's a great tip for expanding your pipeline, keeping your eye on the market, and making sure have a good feeling for the pulse of the market. The relationships you build in the dry season, right? In this winter, those relationships, I'm telling you, are going to be lifelines when the next opportunity strikes, because they're going to think of you first.
Well, I do love a shameless plug. And I can say that because I know that everything we do at Roost is relationship based. And I feel the same way, honestly, about, going direct to owner. I think I've joked before about how my best friend wants to move into my neighborhood and I'm about to go door to door and tell all my neighbors if they're thinking of selling, I'd love it if you'd let me know first so I can let her know. But I think that you can only do it if it's sincere, right? You can't do it if you're one of these.
It has to be real. You're not trying to buy their house for 70 cents on the dollar. You've got a friend who's a retail buyer that wants to get in the neighborhood. They're willing to pay what it's worth. That's two different things. There's nothing
The we buy houses guys are not, there's nothing sincere or authentic about them, but also they're very aggressive, right? And I don't fault them. They're just doing what they have figured out how to do to make it work. And as a marketer, I think that's probably not the worst tactic from an ROI perspective. But if you're worried about relationships, if you want long term, right, which they don't, they want the transactional relationship with you. But if you want a long-term relationship, like I would want with the neighbors who don't end up selling their houses, right, to my friend Lindsay, then you want to make sure that it's sincere and it's authentic and that the goal is mutually beneficial, which is what we do at Roost, and especially with the Investor Gateway. You don't have to be a client to look at our featured investor properties. We just are trying to get them out there so that people will find them. And do we hope that because, maybe they found them on the Investor Gateway that they'll come to us to manage them? Absolutely. But we're not withholding anything if they don't.
No,
it's very authentic and very sincere from our perspective. So I think that's important.
Absolutely. The next tactic I want to touch on is sharpen your strategy and skills. Just because you aren't buying right now doesn't mean you stop practicing. So keep analyzing deals, even if you know you won't pull the trigger. It keeps your instincts sharp and your numbers honest. This is also the time to study some maybe alternative approaches. Maybe this is the time you investigate, seller financing structures or subject to deals or lease options. There's a lot of different ways to approach the world of real estate. And this is the time to get a few more tools in your toolbox before, the next buying season comes along. A deal that looks unworkable at first blush may become interesting when you start thinking about some alternative approaches. One place that comes to mind to learn about these is Bigger Pockets. We have a lot of investors that spend a lot of time in the Bigger Pockets community and learning different approaches to real estate. So that might be some place that you may want to take a look. And the other thing I want everybody to keep in mind is not every deal has to be a home run. A career built on singles and doubles, steady, consistent wins, often outperforms the investor who only swings for the fences. And I think I've learned that over time the hard way. I do feel like in this market, this house I'm going to be closing on later in the month feels like a home run because there's so few opportunities out there. But 3-4 years ago, I would have counted it as a great single or a double.
I don't know if anybody listening plays, and I use that term loosely, fantasy football. I'm going to say touchdown instead of home run here, because if you've played fantasy football, then you've been disappointed by your roster. And I think that when you're drafting, that's the approach that you take, right? What's the biggest name guy? And I got Saquon Barkley this year, which if you know anything about football, last year was just it was a blowout. Every game has scored just barely any points for me this season. But the David Montgomerys of the world, who came in and saved me last year by just consistently scoring a good number of points, didn't have to be, like you said, a home run or a touchdown, but that saved my team. I wasn't in last, I wasn't in first, but I wasn't in last.
Yeah, there you go.
This year I swung for the fences with Saquon and I'm in dead last by myself. And I think that's a really important point, because I do think that that's how a lot of especially new investors approach things, is they're looking for that steal of a deal. And I think it's like that across the board. If you resell vintage items, if you are a car dealer, you're looking for that steal of a deal, but those only come every so often. So I think you're right. Focusing on how you're performing in when it's not a home run or a touchdown is probably far more important than just focusing on those individual home run deals that you get.
What feels like a single right now, and when I say a solid single, it cash flows, it's going to appreciate in value, all the basics. It's just not going to make you rich overnight. But when you're in it for the long term, right, those singles 10 years from now, a lot of times they look like home runs. And that brings us to the next tactic that I'm excited to touch on, and that's using this time to reinvest in current assets. So one of the very best uses of capital in a down cycle is reinvesting in properties you already own. And I only kind of became conscious of this with my own portfolio, maybe in the last 9 months to a year or so, because there's so many opportunities that I'm finding in my own portfolio to do some strategic upgrades that allow me not just to increase the rent, but they're increasing the value of the property, and it's allowing me to attract better tenants. And all that's going to do is, and as you know, I'm going to hold on to these properties, hopefully for another 20, 30, whatever years. It's only going to boost that terminal value. And this whole idea of reinvesting, in what you already have, I've been having a lot of conversations like this with, a lot of our owners who have 2 to 9, 10 to 20 plus properties and so forth. And I think this is the idea. This is actually what's exciting about this fallow period, so to speak. So I'll give you some rough numbers with, and I've actually done this. I'm in the midst of doing it on 2 more properties, but I have a triplex in Springfield, and I have 1 unit that's a decent sized unit. And the rents have run about $600 to $700, and I never upgraded the property. And I never really pushed hard on raising the rents, right? We had, long-term tenants, and, everything was going fine. I was making money. That was all fine and dandy. But this year, the tenant moved out. I went in, and I never do this, but I ended up spending almost $12,000 upgrading the property. I replaced a couple of windows. We did a full paint job. We also did some work that would have had to been done anyway with the plumbing and so forth, but I added an air conditioning unit. And this is not a building where it's necessarily, part of the neighborhood standard or expected that the rental units there have air conditioning, but I did all of that. I spent about $3,000, but I was able to take the rent from roughly $700 to $950 a month, right, on this one unit in a triplex. So help me do the math. So 250, just to make sure I'm doing this right, that's 250 a month, right? Times 12 months, that's $3,000. And if I take that $3,000 and I divide that by the $12,000 that I put in it, I'm getting a 25% return on that $12,000. And plus, I could sell that property today for, gosh, at least 30, maybe up to 50,000 more than I could have sold it for last year, right? So I've added equity, I've increased my cap rate, and I have to tell you, it's easy to get excited about that because that investment has going to have a better return than anything I can buy on the open market today. Think in terms of CapEx, capital expense for rent growth. Maybe it's kitchens, maybe it's baths, maybe it's flooring. Long-term value plays. This is the time to get your roofs changed out. I think I've done 5 roofs myself this year. HVAC, energy efficiency, strategic repositioning, converting a 2-bedroom into 3, cleaning up basements. You don't even have to finish the basements, but now is a great time to get in there and do the waterproofing, get a great paint job, update the lighting and so forth. There are so many things that when I started looking that I can do within my own portfolio that are absolutely going to increase the rents in this market and make them more valuable down the road. I'm kind of embarrassed that I missed them, but it's been so much fun to actually get back into that portfolio this year.
Yeah, I think it's important to note that that's not, and this is not just for, unoccupied units necessarily. You mentioned roofs, you mentioned, there's exterior stuff that you can do to occupied units if you don't want to, bother the tenants to do the stuff inside. But, Nana has a unit that had a long-term tenant in it. It's 2 houses side by side, had a long-term tenant in it, lost the long-term tenant. There was so much work to be done because she hadn't upgraded anything. She hadn't updated anything while he was there. But then there's the property next to it, again, long-term tenants that could use work outside, just some cleaning up of things, but that could make it a lot easier for her to find a new tenant right next door to the property that she's trying to rent, because it's been, she spent a long time having to update it because it had been so long after he moved out, and then also, next door could use some updates. So I just wanted to emphasize that if you're lucky and everything is rented, right, then there's still things that you can do in this kind of section of the strategies and tactics, because, making one house more desirable on the outside can help you rent the one next door when the time comes.
Absolutely. The next tactic I want to touch on is this is the time to prune and reallocate the portfolio. So dry markets are the perfect time to take a hard look at your overall portfolio. Which properties are dragging you down? Which ones generate constant maintenance calls, weak tenant demand, or underwhelming cash flow? I have to tell you, I've had houses that I just could not make work. And for whatever reason, I don't know why. I guess it was just me, because I've had these situations where I've decided to sell them, and the investor that bought them after me was able to do incredibly well with them. But sometimes you have a property, maybe you've got 3 or 4 properties, but one of them is just making you crazy for whatever reason. Maybe now's the time to look at putting that property up for sale. The best investors aren't sentimental, right? I don't think I'm sentimental, but I really do have an aversion to selling because I know how much money I'm going to make over time by taking the long view, the long road. But the best investors, they offload underperformers and they recycle that equity into stronger opportunities. Whether they do if they can do a 1031 exchange, even that makes it even more attractive because you can defer taxes while you're upgrading your portfolio. A lot of times it's as simple as, we've got clients who, say they have a 4 or 5 property portfolio, and 3 of those properties really could use some love, and they end up selling their worst performing property or their most annoying property, and they take whatever equity they can harvest, and they put that money into the other 3 and bring them up to the neighborhood standard. And in turn, they're able to raise the rents, and their overall portfolio is that much stronger. So sometimes consolidation is the smartest move. Other examples, we've had people who, have single family homes, and they get an opportunity to buy, a small apartment building or something like that. So sometimes replacing three, even good to mediocre, they don't have to be mediocre, they can be decent single family homes with a solid multifamily asset can really rejuvenate your portfolio and your future returns.
I feel like that's good advice for the folks who are being very intentional about their investment portfolio. And maybe, I mean, if you've got two properties now, maybe you want two properties, right? Maybe you don't want 30 properties. Maybe you never want to have a 50 property portfolio, right? If you want to stay in the 2 to 10 range, and that's where you're comfortable, then yeah, consolidating or reallocating it could be a really nice intentional strategy for you. Because I think a lot of times we think about, oh, real estate investor, you're always looking to buy, and add more properties, but that's not necessarily the case. Maybe you just want a 2 to 20 portfolio, and that's good for you. So you just have to be very intentional about which properties are in there. It's not always about add.
That's exactly right. That's exactly right. And the final tactic I want to touch on is consider a new personal residence, sorry.
It's a very different conversation.
Yeah. So a new personal residence. Here's a play that a lot of people overlook. In a slow market, moving up personally can be a smart strategy, right? There's a point where competition starts to cool, prices stabilize, and you may be able to, get an offer accepted on your next dream home with a lot less pressure. And we're seeing that, right? We are far from the frenzied market that we saw coming out of COVID. The overall housing market is more balanced than it was even a few short months ago. But this only works, of course, if you are in a financial position to keep the home you're currently in as a rental property. And this works too. This is a great way to, get started in the residential investment business is with the house you already own. So if you can turn your current residence into a rental, you add another cash flowing property to your portfolio while upgrading your own lifestyle. You can lock in the long-term upside on both properties, and this is a move that benefits you personally and also improves your investment balance sheet at the same time. So that's something to consider. Can you do the math, talk to your lender, see if you can actually pull off what would be a great upgrade for you and your family, but keep your current residence as a rental property. Still with me?
Yeah, I just have a little background noise. So
Okay. All right. So those are the tactics that I wanted to discuss today. And the second idea I want to talk about is what I call the long BRRRR. And this kind of goes back to the conversation we just had about upgrading properties within your current portfolio. So BRRRR, which is BRRRR, stands for buying a distressed property. That's the B. Rehabilitating it to increase its value. That's the first R. Renting it out to tenants for income. That's the second R. Refinancing to extract the initial capital. That's the third R. And then repeat the process is the fourth R, right? So that's what the BRRRR process is. So, I think a lot of people have built their entire business very intentionally around the BRRRR method. I have to say that I use the BRRRR method and have constantly for years and years and years. But honestly, I just heard that terminology in the past 2 or 3 years. So I guess that's a little bit embarrassing, but I stand by the process. So what's interesting for me is as I've gone through and started to upgrade my properties and upgrade the rents, some of these properties, I've had for 10, 15 years, and, I've got the mortgages paid down dramatically. Most of them were 20-year loans. If I didn't pay off any principal, I'm already 10, 15 years in. We've had all this appreciation during COVID. So I can actually do the right thing with these properties, increase the rent, and I can go ahead now and refinance these properties and harvest that equity and either use it to pay down other debt or to use it to upgrade other properties or set that money aside someplace safe where I'm not going to touch it and be ready for when the market turns. So my twist on BRRRR, or what I call the long BRRRR, is that you repeat the BRRRR process, but you do it later in the life cycle of the property. So my BRRRR becomes HRRR, right? So it becomes hold. So it's the H instead of the B for buy, and then it's reinvest, It's rent at a higher rate, it's refinance and repeat, right? So, instead of buying and rehabilitating, it's holding, reinvesting. I guess you could call it a rehab upgrade, raise the rent, refinance, and repeat. So instead of buying something new, you recycle what you already own. And the long BRRRR literally looks like this. It's hold, reinvest, raise, refinance, and recycle. Does that make sense, or am I just too excited about this to be clear?
No, it makes perfect sense. And again, we talk a lot about Nana, but she's had most of her properties for a really long time, and this is the exact strategy that she's used to get to where she is. And so, and that goes for the rest of my family as well, because it is really a familial kind of a multi-generational wealth building asset. And so, if that's what you have in mind, if you're building wealth, if that's your goal, then this makes perfect sense, because I don't want to say you're delaying your reinvestment into these properties. If something breaks, you're going to fix it. If you're not going to leave them in disrepair for the sake of her, right? But by delaying it, you really are maximizing, I think,
Right. But we're
your
not really talking about delaying maintenance. I just want to be clear on that,
right.
because we're taking care of the property. The tenants are happy. They're paying the rent. They're paying your mortgage. But what we're talking about is I don't think anybody has the opportunity to maintain their property to the neighborhood standard on a monthly basis or even an annual basis. So this is a situation where, some of these properties I've had for 10, 15 years, I have never made a conscious attempt to keep up with the neighborhood standard, right? And in many cases, the neighborhoods have gotten better. I'm sorry to interrupt you. I'm a little passionate.
No, that makes perfect sense. That's exactly what I was trying to say. But also, by following these kind of rules that Roost follows, right? You set the rent at market rate, right? So you're getting good rent, you're getting the right rent. Then I think that, we see this with Roost clients, with Nana's clients, by getting a fair rent and keeping the property up to the neighborhood standard, then you're more likely to see these kind of long-term tenants. So these
Yeah,
tenants stay in the property for 10 or 15 years, then there's no reason to go in and do a full-on upgrade
right.
until that point. So I think all these factors kind of fit together to put you in this
Yeah.
ideal scenario.
If you've been lucky enough to have a property with no drama for 10 years, well, there's a good chance that, you've got an opportunity there that you didn't need to be aware of, because everything was working the way it's supposed to work. You know, it's textbook, it's drama free. So anyway, to hold, you start with properties you've owned for, maybe a decade or longer, the ones that have performed but are now just a little tired. You reinvest, you put new capital upgrades in there. Maybe it's kitchens, baths, flooring, systems, you upgrade the curb appeal, like you said, on a duplex that Nana might own. You push the rents to current levels. And what I'm finding is I'm pushing the rents by 20 to, in a couple of cases, 40%, because I just wanted to keep long-term tenants in there, right? It makes a lot of sense as an owner, for a certain period of time to take, a discount against what's possible, in order to avoid having to go in and spend money on a rehab between tenants. So it's not a bad thing if your rents have maybe not kept up with what's possible. But when the time comes to when a tenant does move out for whatever reason, it would be a sin not to take advantage of where the market is today, right? So we hold, we reinvest, we raise, and we refinance. We execute a cash out refi at a new higher value, and we take that cash and we do something else with it. And we've talked before about our relationship with Lending One. They are a lender that only works with investors who have their properties in an LLC, and they do these DSCR loans, basically, that value the property based on what the rent is. And they have amazing products right now that where the interest rates are competitive with what you're going to be able to get at a local bank. So, and they do refinances also. They also do blanket loans and so forth. So here's another shameless plug for Lending One. Maybe we can put a link to the webinar we did with them in the show notes of this episode. And then recycle, right? The last R is recycle. Pay yourself back for the upgrades. And many times, you've got additional money that you can put back in your, pocket to, or back in the bank for the next selling season. So hold, reinvest, raise, refinance, and recycle. That's the long BRRRR for seasoned landlords. Instead of growing by acquisition, you grow by reinvestment. And obviously, it's perfect in seasons like this because dry markets are frustrating. Acquisitions don't pencil, but sometimes these long BRRRR opportunities pencil out incredibly well. So you get forced appreciation without buying. You create more liquidity. Your portfolio gets literally physically stronger, and you can pocket cash for the next cycle. The congregation may be seated, Laci.
No, I think that's great. And I think that, the refinance point is a really good one because a lot of these strategies or tactics that we're talking about today, they seem to appeal to folks who have been in this a long time and have some, cash or some liquidity kind of already, or some assets to tap into. But with the refinancing thing, and especially, based on how much your rental is actually renting for, I think that really gives folks who maybe still do have a mortgage payment on these properties, they haven't paid them down all the way, some extra options.
Yeah. Yeah. It's, I go back and forth between, do I want to pay all these off? Because if I paid off all the mortgages, that's an incredible amount of money every month. Or do I want to take the approach that the thing about paying everything off makes it sound like you're going to stop, you're going to retire, you're not going to play anymore. And I can't quite stomach that. So I do think that there's a balance that I'm looking to strike between some houses that make sense to just hold and be paid off, and other houses that, you go back to and you tap equity every 10 or 15 years and continue to grow that investment business, if not for yourself, then, for the kids and grandkids. So, but having said that, there are some risks that you have to manage. The last thing we want to do is put somebody back in a position so many of us found ourselves in back in 2008. So don't over leverage. Don't strip out all the equity just because you can. You want to leave yourself a cushion so that you don't get caught if things happen to turn south. Be conservative about what you think your cap rate truly is. Appraisers lean really heavily on rent comps, so make sure your increases are realistic. The last thing you want to do is to try to push the rents as high as you possibly can in order to get a certain value for the property, get that loan done, and find out that the tenant can't stay because they can't afford the rent, or worse yet, they can go ahead and rent another house down the block for $200 or $300 less than what you're able to rent for. And rate sensitivity, model your refinance scenarios at different interest rates. A good upgrade can not be a good upgrade, right? If the debt terms don't work. So handled with discipline, I think the long BRRRR is safe, it's highly profitable, and it's a great way to put money to work in the slow seasons. So as we wrap up, I want to go into our third topic of the day. And, in the first episode, we talked about different seasons. And what I did was my good friend ChatGPT and I went back and researched how the Columbus market area fared in terms of seasons over the past 30 years. So how's that for excitement, Laci?
Yeah, I'm excited about this one because I'm not from the area. So while I've been
know.
here where I am for 30 years and have seen it firsthand, I'm interested to see if there are any differences, or if they mirror each other as far as the history, because I live in a smaller town. Columbus is a pretty big city. So I think there are intrinsically some differences there, but I think that that's the mindset I would love for people to go into this with, which is how does this compare to, this is not necessarily how your area has been dealing with it, but how does this compare to my area?
Yeah, it gives you a reference for how you might evaluate what season you're in and the market you're in. And I'm not here to say this is the most exciting thing in the world, but for real estate nerds like myself, it's kind of cool. So we're going to go through it, and we'll have this in the blog post as well. So Columbus seasons, real estate seasons. So in the 1990s, Columbus was characterized by slow and steady growth. Columbus in the 90s was a very different city than it was today. The population was growing, but it was very manageable. Home prices climbed slowly. There were no wild swings like you saw in the coastal markets. The mortgage rates were a little higher back then, but they were drifting downward from levels in the 80s that were just outrageous. So for investors, the 90s in Columbus was largely a neutral season. Deals could be made, but you had to really control your value creation, right? You had to buying a property at retail and waiting for appreciation wasn't necessarily a winning strategy. Smart operators invested in small multifamily, and they focused on cash flow. The discipline built in the 90s set up Columbus investors to thrive in the decade ahead. So if somebody was really focused on what they were doing. They had a sharp pencil, a good buy box, and they were disciplined. The houses that they purchased and held on to in the 90s are, gosh, worth hundreds and hundreds of thousands today. So you move out of the 90s, which was a neutral season, and you move into the period 2000 to 2006. So this is characterized by expansion in an early seller's market, right? The early 2000s brought faster growth to Columbus. Population gains, steady job creation, there was easier financing. So things were going crazy in real estate in Columbus. But by 2004 through 6, Columbus was riding about the same wave as the rest of the country. It was a hot time, right? Prices were climbing fast. And actually, that was a point where incomes stopped keeping up. And lending standards back then were loosening up. And a lot of investors, myself included, I'm sorry to say, got very, very aggressive. And this became a shift into a seller's market. Properties started to sell quickly, sometimes above asking. Many investors stretched, and banks stretched their underwriting. They were confident that based on what they'd seen the past few years in the early 2000s, that values would only go up. Appreciation would bail them out of any mistake they might made. Now, on the other side of it, the seasoned investors, the ones that had been at it for a long time in the early 2000s, they used this as a time to prune their portfolio. They sold their problem properties, they consolidated, and they got prepared for what was coming next. So this is a great situation where what can be a seller's market can either work for you or work against you. To sum it up, 2000 to 2006 was characterized as a seller's market. And then we got into the Great Recession and the true buying season. So this was 2008 through 2012, right? If you remember, we had a massive crash in 2008 and 9. Now, what was interesting is, Columbus is home to the Ohio State University. It's the state capital. Neither one of those are going anywhere anytime soon. So Columbus didn't see the extreme price drops that places like Phoenix or Las Vegas saw, but the values still fell. Supply swelled, there was a lot more houses on the market, and this is the key, financing got super, super tight. So between 2008 and 2012, you could buy houses in almost every part of Columbus for less than it costs to build them. And this was obviously the clearest buying season in the past 30 years, maybe longer. Investors with cash, a little bit of courage and conviction, they were scooping up properties at discounts that, looking back on, are just crazy, whether they got them at sheriff's sale or the real estate owned properties that banks were offloading. There was just so many opportunities if you had the cash and if you knew what you were doing. If you'd been patient and you stayed liquid, right, during the early part of the 2000s, you were rewarded with the buying opportunity of a lifetime. I sold so many houses during that period to investors I work with, and fortunately, I was able to buy a handful of houses during that time as well. And it was a magical time, Laci. I don't know that we'll ever see that again, but anything that comes close is just, I just can't wait. Quite
Well,
frankly.
part of you hopes no, and part of you hopes yes. So.
That's exactly right. I don't want to see anybody get hurt, but oh my gosh, myself, the investors we work with, the agents we work with, there was just so many opportunities. I mean, and yes, it was a dark time. It was dark for us, personally in many respects. But as for an investor, who was prepared during that time, it was the buying opportunity of a lifetime. And then in 2013 through 19, right, from basically coming out of the crash in 2013 all the way up until COVID, long expansion and a neutral to seller's market. Right, so we went from a neutral market in the 90s, a seller's market in the early 2000s, a true buyer season in post crash, and then we came into another neutral, maybe neutral to seller season. So the recovery during that time turned into a boom. Columbus grew into one of the fastest growing metro areas, not just in the Midwest, but in the country. We had tech jobs, we had logistics and warehousing, education, research. Home prices climbed year after year. 2015, 2016, bidding wars were common. It was just clear that it was a great time to be a seller. For the investors, of course, the best buys were in the early part of the decade. By the end of the decade, of the 20 teens, the only deals that made sense were value add plays, properties that you could upgrade, reposition, buy off market, etc. So it was a neutral season for disciplined buyers, and it was a seller season for everybody else. And then we got into COVID, right? And COVID was just the craziest thing in the world. And I think we're still having a COVID hangover, to be honest with you. So just in 20 to 2021, there was a frenzy, cheap money. I think people were at home. They had more time on their hands. They're looking at Zillow. They're buying houses there in California. They're buying houses in Ohio. You know, when interest rates collapsed during the pandemic, Columbus saw a frenzy, right? Inventory evaporated, rates hit new lows, demand spiked, prices surged double digits in a single year. It's a classic seller's market. Investors who chase deals in that time often find themselves overpaying and betting on appreciation that couldn't last. And we have, sadly, we have a handful of owners who did buy a lot of houses at the peak. There's some houses at the peak during COVID, and they're not super happy with their investment today. And, they're doing the best they can to hold on because, as I always say, this too shall pass. But it was a dangerous time for investors to be buying up properties anywhere in the country, but especially in Columbus, Ohio, during COVID. The smartest players, the experienced players, either sat that whole period out or they only bought when they had a true edge or a true reason. And then we get past 2021 and you hit 2022, 2023, and suddenly we start to get a little hangover, right? We got a rate shock. Interest rates on mortgages doubled in less than a year. Demand cooled off. But Columbus, the supply stayed tighter. Prices started to flatten a little bit, but they certainly didn't collapse. So 22 to 23 was a kind of a strange neutral to, I'm going to say, winter or fallow season. Those three dials weren't lining up for acquisitions. Deals that might have looked good in 2021 at a 3% interest rate suddenly didn't pencil out at all at 6, 7, 8% interest rates. So again, savvy investors, they shifted into reinvesting in their existing properties. They proved the weak performers, and they started banking cash. And then we get to basically where we are today. Call it 2024 to 2025, and today we're in a kind of a transition period. So right now, active listings in the Columbus metro market are definitely up compared to the depths of where we were in 2021. But the number of houses on the market, whether they be investment grade properties or properties people want to live in, the number of houses for sale is still well below historic averages. Prices are still going up a little, but they've kind of plateaued. They're certainly not surging. I won't even say rates have eased up. Any given week they're plus or minus a half a point. So clearly there hasn't been enough relief in interest rates to unleash a flood of buying. So it feels like right now, and this is kind of what brought us to this podcast today, is we're in a period of hibernation, and it's kind of a long hibernation period. It's not a buyer's market yet, but the signs are starting to shift. Investors who are protecting their portfolios, upgrading, building liquidity, and so forth, they're doing what they need to do, and they're the ones that are going to be poised to do really well when we come out of this hibernation season. And I truly believe that this too shall pass. That next buying season, or at least the next neutral season with opportunities for investors, will come. I don't know that it's going to be as soon as next spring, but I would say in the next year or so, we'll start to see some green shoots, as they say, for residential real estate investors.
Yeah, I mean, that's the pattern that I see in all of this is, the buying seasons are really few and far between, right? When it's truly a buying season. And if you look at things like COVID and, obviously the crash of 2008, that kind of 4-year period there, then there are also some questionable parts of those buying seasons that might affect potential buyers, right? So if you lose your job, or if your hours get cut, or if something else happens, your health goes downhill, then that might not put you in the right place to take advantage of the buying season. But so you really do have to be ultra prepared. And I think that preparedness portion is a huge part of it. But just acknowledging that, they teach us in school to learn history so we don't repeat it. But in this
Mhm.
case, in the case of real estate, right, we want to learn history so we can repeat it. So we know,
It's
so
a
we can
great point.
identify, right, when the time is right, so we can have our finger on that pulse. And so we can then repeat it the right way, right? Maybe we didn't get to take advantage of it last time, or maybe our parents didn't get to take advantage of it, in my case, or somebody else in my age's case, but maybe we can take advantage of it this next time. And if we can keep our finger on the pulse and kind of, like you said, people exist, like people who have experience in this, experienced investors kind of know what's coming, then you really can position yourself in that place to take advantage of these very rare buying seasons.
Well, I'm going to say, I'm going to go out on a limb and say that we're overdue for a correction and we're overdue for a buying season. The last real buying season we had was 2008 to 2012. God forbid it becomes that kind of opportunity because there was so much collateral damage. But, that was only really a 4 to 6 year period where we had a buyer season out of 30 years. So most years were neutral at best, had definitely some interesting seller periods, but a lot of neutral, a lot of fallow periods, a lot of winter periods. And you just have to believe that, like I said 3 times now, I think this too shall pass. And I think we will start to see some opportunities in the next few months, year and a half for investors.
I just think it's so encouraging for the average everyday person that, real estate investment is generational wealth building for all of us. It is not exclusive to the moguls, to the billionaires. If you are smart, if you have, the means, enough of them, you can invest. You can make these decisions, even if it's just turning your existing house into a rental when you move up to your next house. This is something that's available to everybody and that people can really take advantage of to build wealth generation to generation, even without just, huge amounts of assets sitting around. So I just think that this whole conversation should be very encouraging to investors in all of the stages, because it truly is, real estate is truly a wealth building tool that's accessible, to most folks.
Yep, absolutely. So as we wrap up, I just want to reiterate, in every market season, there is a right play. The winners over the long term aren't the ones who always buy. In fact, the real winners, out of the last 30 years, maybe they had 4 big buying years, right? But they're always the ones who play the right game for the season they're in. When deals dry up, average investors just freeze, right? The best investors, they figure out how to shift gears. They focus on their operations. They focus on liquidity, cash on hand, relationships, skills, right? Whether it's valuation skills, acquisition skills, what have you. And they also focus on reinvestment where it makes sense. And they pull that equity out and set it aside for the future when they can. They prune what isn't working and they prepare for the next opportunity wave. And again, the seasons will change. They always do. And when the next true buying season arrives, those who use this downtime wisely will be the ones that are going to be ready to go on offense. So before we wrap up, I just want to remind our listeners that at Roost Real Estate Company, we're not just property managers. We see ourselves as true partners in asset and portfolio management. So our last shameless plug of the day, Laci, if you're a serious investor, it's not just about collecting rent checks. It's about protecting your capital. It's about maximizing your return on investment. It's about making the right moves at the right time in the cycle. And that's where we come in. We work with investors of all sizes. We work with mom and pops. We work with accidental landlords. We work with professional investors to manage not just the day-to-day operations, but also to help with the big picture strategy. And again, that goes back to, does it make sense now to prune underperformers, to put a few houses up for sale? Does it make more sense to reinvest in existing assets? And we've got a fantastic rehab and maintenance company, the Roost Rehab and Maintenance Company, to help our owners with that. And just the whole plan for repositioning your portfolio to take advantage of the next buying season. So if you're ready to work with a team that treats your properties like an asset manager would, with a focus on growth, stewardship, and long-term profitability, then we hope you'll reach out to us. Laci, I enjoyed this, but I'm a real estate nerd, so thanks for being here, listening to me ramble today.
No, I think it's great. More shameless plugs, I say, and we can do that because we're focused on the relationship, right? We're focused on, building a relationship with our investor clients that spans all of the seasons and being
Yeah.
alongside of them for all of the seasons and helping them be in the right position when the next buying season comes along. So more shameless plugs, I say, not shameless at all when you're focused on the relationships like we are.
All right. Fantastic. Thanks for being here. We'll see you later.
See you next time.